Well, anyway, be that as it may, I'm sorry that your seminar coincide with a holiday, but still, let's start it. Let's welcome everyone to the Innovation, Productivity, and Challenges in the Digital Era webinar sponsored by ABFER, CUHK, Tsinghua, and Fudan. Our paper is called Reducing Racial Disparity in Consumer Credit Evidence from Anonymous Loan Applications, written by Professor Tianyue RUAN and also Poorya KABIR. Tianyue will be presenting in 25 minutes, and then Pulak GHOSH from IIM, the Chair of Excellence and Professor of Decision Science. He will have 20 minutes. Tianyue, please take the forum.
Okay, cool. So let me share my screen now. I have shared my screen. I hope that everyone can see my screen, my slides, as well as hear me clearly. So thank you very much for inviting me to present this paper. This is joint work with my colleague at NUS Poorya. And today we are going to talk about the role of anonymous loan applications in reducing racial disparities. So the motivation of our paper is that access to credit is very important for firms as well as for households. And there has been a large literature up to now documenting that the access to credit and terms of credit is unequal across different demographic groups. Specifically, there are stark racial disparities in these access and terms of credit. This is not unique to credit markets. In fact, the racial disparities is a widespread phenomenon across many economic settings. And there have been one type of policies that aim to reduce such racial disparities, namely restricting the use of information predictive of race. So for instance, in the credit market, the US Fair Housing Act prohibits the use of neighborhood racial composition for lending decisions. In the insurance market, this law in California, Proposition 103, excludes zip code from variables permissible for insurance pricing. And in the labor market, policies such as Banner Box serve a similar purpose. Basically, this type of policies restricts employers from asking about applicants' criminal history on job applications. And such policy has often been used as a countermeasure for the stark racial disparities in the credit market. So one specific policy of this type is to remove a racially identifying variable, applicant names. And such policy proposal has received considerable attention from policymakers. So one support for such policy is a large body of experimental evidence of discrimination based on name in various economic settings, such as labor market, rental market, and credit markets. Some of the important works are cited here in this slide, but there are many similar experimental studies document similar findings. So if we extrapolate from these policies, we may argue that if decision makers are discriminating based on names, perhaps removing names, from the evaluation procedure would have the beneficial impact of removing racial disparities. But we don't actually have any concrete evidence for this, and especially in the credit market, this is where our paper comes in. So we are going to focus on a specific setting where loan applicant names are removed from the lending decision. And we believe that in the current era of digital technology, especially the widespread use of fintech, such policy, if they work, can actually be scaled to other settings because technology enables cost-effective implementation of anonymous applications. So let me give you a high-level summary of what we do in this paper. So we studied the effects of anonymous loan applications on racial discrimination in a specific market called personal loans, which I will be more specific. The data we have comes from a leading online personal loan comparison platform here in Singapore. So we observed the entire process of obtaining credit from loan applications, loan approvals, originations. And the setting we have is that initially this platform shows applicant names to lenders when these platforms send out applications to various lenders. Since September 28th of 2021, this platform changed its practice. It removed the applicant name shown to the lenders in order to protect customer privacy. So we refer to this change as anonymization or anonymous loan applications for the rest of this presentation. So we want to highlight that this anonymization does not completely remove race from the decision process, because in the process of getting a loan, eventually the loan applicant need to visit the lender in person to have their identity verified. So in a way, this anonymous practice delays the revealing of race information to lenders. So what do we find with this delaying information? We find that when names are on the applications, the ethnic minority applicants are 10.6% less likely to receive online loan offers than otherwise observably identical Chinese applicants. So, and we find that anonymizing these loan applications completely eliminates such disparities. This is before the information on race is revealed to the lender. Once we advance to the subsequent stage of loan origination, despite that race is fully revealed in this stage, racial disparities still decrease in terms of loan origination. And we also track the loan performance for a subset of our sample due to data limitations. We find that there's no racial gaps in loan performance either before or after the change. Okay, so let me talk about the setting in greater detail. So we first want to argue that our setting basically captures the comprehensive picture of key stages from the credit process, from the initial applications to loan originations to loan performance. And we also want to highlight that compared to some existing experimental studies on anonymous resumes that primarily rely on voluntary participation of the hiring firms, the decision makers, our setting is not affected by the self-selection into the natural experiment. Namely, all the lenders, all the relevant decision makers in our setting, they receive anonymous applications once such practice is established. So our setting is the online loan comparison platform. This has been gaining popularity due to the widespread adoption of technology in credit. So such platforms are available in many countries. In our setting, we focus on one platform in Singapore. So this is the process of obtaining loan through such platform. So the loan product being offered here is referred to as personal loan. These are unsecured, short-term, and high-cost loan to consumers. So this type of loans is also known as cash loan or consumer loan in some other settings and studies. So what happened through this platform is that first, potential loan applicants, they fill out an online application through the platform that would only take a few minutes. The platform would send such application to different lenders that these platform partners with. The lenders will review the online application and decide whether the lender want to reject this particular application or want to extend a loan offer, which include the following terms: the amount, the maturity, the annual interest rate, as well as a processing fee, which would factor in the true cost of borrowing. Once the applicant receives offers from multiple lenders, they will see those offers in their online platform through this online portal through this platform, and then he or she can compare different offers and select one online. So the last stage here, okay, once the applicant selects one offer, he or she will need to visit the lender in person to have the identity verified and sign the agreement to get a loan origination. So this last step, okay, is required by the main regulator of money lenders in Singapore, the Ministry of Law. And the existence of this last stage also means that while after anonymization, race is removed from this stage, race information will be reviewed in this final stage of in-person.
May I interrupt you?
Excuse me, is there a question?
Yes, I would like to just clarification.
Sure.
From step 1 to 4.
Yes.
Is there any possibility that an offer got rejected or changed when there is an interview after the interview?
Oh, in the last stage, yes, we do see some of the offer came after being selected was not result in a loan origination at the final stage.
And do they change the terms and so on?
Excuse me?
Do they decide? So from jumping from 1 to 4,
yes.
Does the lender has the right to retract the offer, has the right to change the amount, the interest rate, and all the other terms, right?
They can change in the final stage of in-person visit. That's
Thank you.
One thing we look at. Yes, thank you. Okay, let me continue. So this is the process. So our data basically captures all these steps. So we obtain data from this platform. Our data lasts about 16 months from October 2020 to January 2022. So we have the comprehensive set of information these platforms collected on the applicant, including their name, their age, nationality, residency status, income, zip codes, their address, occupation, housing, and existing borrowing. We observe in the step 2 in the previous flow chart, what is the lender's decision, whether the lender gives an initial offer and the terms of the initial offer. We then observe the third step, how the applicant choose among these different offers. And we also observe the final in-person visit stage, whether the applicant received loan origination and whether the terms of these final loan contract compared to the initial offers. So this is the data we have. So we are interested in the racial differences, whether there's any such differences. So the key for us is to measure a minority group. So as many of you know, Singapore is a multiracial city-state with a resident population that consists about three-quarters majority of ethnic Chinese, 13.5% Malays, and 9% Indians. So in this paper, we use the term minority to refer to all non-Chinese races that include Malays, Indians, and other races. So our approach is quite standard. It's in the literature. We basically hand match applicant names to races, as these different racial groups, they have distinct name patterns. And finally, we restrict our main sample to those applications whose information is pre-filled directly from the government database. Such filtering has two advantages. The first is that official records, from the government database offers a higher data quality as opposed to self-reported information. And also, in order to do this pre-filling from government database, these applicants need to actually consent, provide their consent. And this applicant consent helps us screen out certain spam applications, similar to a captcha verification in many web applications. So let me show you the application characteristics. So we compare the differences between minority group and the Chinese group in terms of age, whether it's female, whether they live in public housing, and their annual income, before and after the anonymization change. So we can see that minority and Chinese applicants, they are different in terms of these observable characteristics, but the difference, okay, stays relatively stable before and after the change. So minorities are on average younger, more likely to be female, more likely to live in public housing, and has a lower income relative to Chinese, both before and after the anonymization. So we are aware of these observable differences. In our estimation, we will explicitly control for these observable differences, and we focus on the before and after change in terms of credit outcomes. Okay, so let me show you unconditionally whether the anonymization makes a difference in terms of credit outcomes. So we do see that in terms of both the extensive margin and intensive margin of credit outcomes, minority and Chinese applicants, they have different, they have differences. Okay, especially in the before anonymization period. So they are less likely to receive an offer. They receive smaller offers, more short-term offers, and they face a higher effective interest rate, considering both nominal interest rate and processing fees, and they are less likely to receive the final origination. But okay, even in unconditional comparisons, we see that many of these differences, okay, become much smaller or insignificant in the post-anonymization. So this is, I think, without controlling for the various covariates, this is the first pass evidence that anonymization reduces racial disparity. So we also, motivated by this fact, we also analyze racial disparities in a regression framework where we include all the relevant covariates. So specifically, this is the panel regression we run. So we analyze the credit decision of lender J for application I, whose timing of these I is denoted by T. And minority here is the indicator for minority applicant. So we have two timing indicators, pre and post. So whether they are indicating whether the application is before and after September 28, 2021, when the anonymization practice is established. So this beta pre, which is the coefficient of minority indexes pre, reflect the racial disparity in the pre-period. Okay, analogously, beta post, which is the coefficient on minority index with post, indicated the disparity in the post period. And we are interested in also in the difference between beta pre and beta post, which we call delta beta. So this can be interpreted as the treatment effect in a standard event study setting. So we include a host of control variables. So first, we include lender fixed effects separately for the pre and post period, which allow lender decisions to be different given the different information set. We have year-month fixed effect pi t, and we also include all the application characteristics observable to lenders when they receive the loan applications. We denote such observable characteristics by this vector x. So we allow the effect of x to differ in a pre and post period. Okay, so this is the control variables we include. So I want to highlight that since the evaluation of applications and the extension of initial offers are fully done online, we observed all the characteristics that lenders observe. So the typical omitted variable bias is going to be less of a concern in our setting. And we also cluster robust standard errors at the lender month level. So let me show you the results. So first, I want to talk about the first column, where we find that before anonymization, minorities are almost 4 percentage points less likely to receive an offer than the observably equivalent Chinese. But once we move to the post period, such differences completely disappeared. So if we look at delta beta, which is the treatment effect we are interested in, and consider the economic magnitude, so relative to the mean of these offer indicators, these delta beta represent a 10.6% reduction in the disparities. So if we insert a different parametric form for these control variables, we observe a similar magnitude. And if we aggregate the data differently, so instead of this pair level, application lender pair, but supposed to that, if we aggregate everything up to the application level, okay, where we look at average offer probability, we observe the similar thing, okay. Before anonymization, there's significant sizable racial disparities, but in the post period, such disparities disappeared. So this is our first main finding. Disparities in initial online offer probabilities disappear. So we also trace out the dynamic pattern, okay, in such racial disparity. So in this dynamic results, if we see a greater than 1 beta S, it means that minorities are less likely to receive initial offers. If we see a negative beta S, it means that minorities are less likely to receive offers, which is a racial gap. We do see that in the months leading up to the establishment of anonymization, the racial disparities stay relatively stable, okay? And the change only happens after the anonymization is introduced and stay relatively stable afterwards. So this dynamic pattern also supports the parallel trends assumption in this setting. So we also, okay, in order to understand, whether these such racial disparity is driven by a particular income group, we also do this analysis by different levels of income. This plot, okay, shows the pre-anonymization disparities across different quantile groups of income. We do see that it does not seem to vary by income group. And if we do it by debt to income to debt ratio, we observe similar, stable distribution across these different quantiles. So I think in a very limited time, let me talk about the second stage when race is revealed, okay? So we argue that if we only focus on the last stage, actually the information set does not change for the lenders, because one way or the other, they observe the race information, so they can use that to completely undo the differences in the initial stage. But is it the case? So the results, it seems to suggest that while, okay, lenders adjust to this new information by, declining slightly more minority applicants of loan origination, if we consider before and after change for origination, we find that it still is a reduction in the disparity with slightly smaller economic magnitude. So this magnitude for origination is about 80% the size of initial offers, which means that although lenders adjust to these newly reviewed race information in-person visits, they do not fully undo the reduction in racial disparities from the first stage. So this is our result if we look at application lender level, this pair level. If we do it in a slightly different aggregation, we obtain slightly different coefficient estimates because the specification now is also different, but the same pattern is there. Namely, the reduction in racial disparity in origination stage remains significant, okay, even though lenders do see this newly reviewed race information. So if you compare these two these two economic magnitudes, this represents about 20% also partial adjustment. Okay, so I think I'm close to my time. So let me just
running out of time.
Yeah, let me just talk about one other thing,
minutes,
which is low performance. The sample is smaller because of data limitation, but we do find that there is no differences in loan performance either before and after the anonymization change, which suggests that it's the performance difference or credit risk of these applicants are unlikely to explain our results. So let me skip this too and then just talk about, briefly talk about what kind of discrimination theory best describe our finding. So we believe that two pieces of relevant tests and evidence suggest that accurate statistical discrimination cannot explain our findings. First is that if you think income is a proxy for repayment ability, we do not find repayment ability affect racial disparities. So this is not a driver of the racial disparities. And we also, using a model-based framework to infer what lenders believe about these different applicants, we find that lenders' beliefs are highly inaccurate, which is also at odds with accurate statistical discrimination. So let me wrap up. So we find that anonymizing loan applications can at least partially help minorities and reduce racial discrimination, because we see that racial disparities in loan offer probabilities completely disappear once names are removed. And in the eventual loan origination, racial disparities also decrease by a meaningful magnitude, even though race is reviewed at this stage. So we find that such cost-effective method can be quite helpful in the digital era to improve equality, because even though it does not completely remove race information, it still, by delaying this revelation of race, it can still reduce racial discrimination. Okay, so this is all I have, and thank you for letting me wrap up with a little bit over time.
Thank you. Thank you, Tianyue. Thank you for the excellent presentation. And Pulak, will you please? 20 minutes, 25 minutes.
Thanks for inviting me. Tianyue, great paper, great presentation. So let me, hold on. Yeah, so this paper is about, a possible way of reducing the racial disparities in access to credit. Now, racial disparities have been an ongoing concern, as Tianyue also made in her paper and presentation. So the policymakers all around the world are trying to, figure out ways to reduce it almost in every field, right? So this paper particularly tries to figure that out in the context of credit access. Now, three things very interesting in this paper, apart from several other things. One is it has a very unique experiment rather than controlled trials and several other administrative trials where there is a selection bias. So this is a very unique experiment where full names are anonymized by the platform at the time of application processing. Very interesting and rich fintech data, and the authors have done a lot of tests, robustness, to check the findings. Now, so a little bit background. So they got the data from a Singapore-based fintech platform, which provides short-term unsecured consumer loans. And generally, if in a non-collateralized loan, the interest rates are very high. So they analyze the loan offers, loan origination, and this is particularly interesting because another interesting feature of this entire experiment is the sequence. So during the loan application, the platform make the names anonymized, but then at a second stage, they have to, the borrower who get the offer and accept the offer, they go to the particular lender, and then the lender actually knows everything from the risk point of view of the borrower. Now, this is something new. So that's another unique setting they have, and their data is from 2020 to 2022, somewhere in the middle, which is around September 2021. The fintech platform started this. So using this as identification, this paper tries to test the effectiveness of anonymizing in reducing racial gap. As I explained, very rich data set, detailed application characteristic, including derived race. Now, lending decisions are at the end of the day done by the loan officers, though, or the lenders. And loan origination terms, we observe amount, maturity, interest rate, and processing fees. So interest rate and processing fee apparently looks to me varies across the loan. So which basically means, in my understanding, is that the same borrower, if they come twice or thrice in the platform with the same amount, the interest rate and processing fee may vary, because there is some fintech where these are fixed and this varies across the product, but looks like that's not the case here. And the authors have a subsample or a subset of the sample where they also know the loan performance, so they can figure out the delinquency rate and all those things. Okay. So here are the main findings of the paper, which is basically before the identification or the treatment, the racial gap in this platform was significantly as high as 10%. And that disappears post-treatment period, so economically sizable number. And then decrease in loan origination. So remember, there is two stages. One is loan application, and you get an online offer, and then actually you go and meet the lender. And there is a chance, and in some cases it has happened, as the papers say, that during the loan, when you meet the lender can actually reject your loan also for various reasons, including knowing your race. But even in that scenario also, post-anonymization, the loan origination rate decreases by, in terms of racial gap, decreases by 8%. Now, what about the loan performance? So the average delinquency probability pre-treatment is actually lower for minority. That means before the treatment happens, the lenders were actually giving loans to the minority, conditional, they're giving loan to the minorities who has a very high credit score, let's say, or quality of the borrowers. Post-treatment, the probabilities are same, both for Chinese and minority borrowers in terms of delinquency. Okay. In terms of mechanism, not related to the omitted variable bias, that's what the paper says. And they obviously, the setting is a little tricky, so cannot distinguish between inaccurate beliefs and test-based discrimination. However, they've shown that the statistical discrimination cannot explain the results, and also there is no in-group preferences, because majority of the lender are from the majority group, which is the Chinese. So the question of in-group bias probably doesn't exist. So let me now come to a couple of thoughts. It's a pretty well done paper, very topical, and very great detail with a careful analysis. So some thoughts here. Let's first look at the data and the institutional detail. Now, I couldn't figure out from the paper whether from the lender side, can one lender fund multiple loans? How many and how much? So for example, a lender can build a portfolio by fractional loan. So in some cases, there is some central bank regulations happen to the typical P2P kind of platform where they restrict by saying if a borrower asks $100, no lender can give the full $100. They can give certain 15%, 20% max of the borrower. And so there is a pooling across the lender. So that's what I meant that was not clear. On the other side, can multiple lender fund one loan, right? So these two needs to be a lot more put in carefully, because it's not very clear by reading the paper. Another very important aspect of the borrower side is missing is the credit score. Now, I understand these were payday kind of lending, but then the average loan tenure is around 6 months. So this is not a typical payday lending where the payoff is almost like daily or monthly, weekly, right? So is the credit score, this platform doesn't ask from the borrower, or these are new to credit customer? So that part is not clear, because as I will explain, if the credit score is there, then teasing out the mechanism becomes a bit easier. And we don't have characteristics about the lender except their race, but we don't know their age, or there are several other things, right? The other thing is the platform or this entire fintech, thing is always giving one product, or there is different products. Now, different products can be from different angle, in the sense I can have same thing, but with different maturity. And because of different tenure, I can have different interest rate. Does the interest rate changes with maturity period? And then another concern is that the majority of the data period covers COVID. So these are some of the data and institutional detail which probably needs to be teased out or written down a little bit more in detail. Now, let me come to the economics of it. So the racial disparity reduces drastically, and it's a pretty big number. But the paper stops short of saying how much the money lender, how much money the lender lose if this does not happen. In other words, can we develop some kind of back of the envelope analysis? Now, I'll tease that out more. So another angle is that are discriminating returns lower? So should we care about the expected IRR? One way to do that is, because we know the interest rate for each loan, we can test whether the discriminating loans pay lower or similar interest by, let's say, regressing the interest rate as the left-hand side. Now, why I'm saying that is the paper talks and shows very nicely that the racial disparity decreases, but what is the effect of that on the larger picture from the economy point of view is an important aspect probably we need to look at. Another big thing which I don't see the mention is why the authors didn't look at the reject loans, because that also gives a lot of information, right? So are the characteristics of the borrowers who get rejected are similar across the accepted? If they're different in what? Are they, ideally, they would be different in terms of the credit score. If it is not, then, how does the fintech platform develop the underwriting model? So that is one thing was not clear, because the author says that it is not developed by AI model, it is done humanly. Now, if it is done humanly, then what are the variables become important as an input in the underwriting model if credit score is not taken care of, right? So that's why it becomes all the more important to look at the reject loans. The other important thing that if we have the reject loan would be to develop a prediction counterfactual on the reject loans. And this is something, there is a paper by Sendil Mulanathan in QJE where they develop these techniques where you can actually show that how many loans would have been accepted if the treatment is or rejected if the treatment is enforced or not enforced. And that again goes back to the back of the envelope analysis to figure out how much effect it has on the larger economy. Then on the aggregate effects, if we look at the borrowers, what kind of borrowers actually getting this new credit or getting rejected? So are post-treatment more safe borrower getting the new credit or more risky borrower getting the new credit? Both pre and post. The same thing for the lenders. Do the lenders pre and post changing how they choose? So are they investing more or are they investing less post the treatment, right? Or it's just a portfolio effect we need to look at. So these are some of the points we need to tease out. Probably the authors can take a look at to figure out the issues. Coming to the mechanism. So if we look at test versus statistical, then maybe we can look at different size of the loans or different stakes, right? So if there are higher stakes, the likelihood of test lower given the cost or versus the benefit, right? Now, is there a time trend in the sense that September 2021, the anonymization or the treatment came in force. Now, after 6 months, after 8 months, after 1 year, does the effect is or the results are similar? In the sense, there is a robust to the time fixed effects. One way to look at it is, just look at all the loans in the end. Another thing is that our delinquency is correlated over time. This particularly, in my mind, this question came because only the last few months of the loan total duration of the data, we can say it's kind of free of COVID. So can you drop the recent loans and redo the entire analysis to look at that? Now, if we come to the mechanism again, as the authors rightly pointed out in the paper, so there is three main things which can be playing a role here. One is the statistical discrimination. And so is it that post the treatment, the lenders has adverse selection? So they basically, one way they were choosing before was based on race, but now they don't have that. So they are basically getting the poor borrowers or, poor credit worthy people. And that is a test-based discrimination. Another is a favoritism. Now, in-group bias, the authors have nullified, but is there any home bias in the sense that, between two pin codes, the lender and the borrower, the distance is very small, so the lender is more exposed to that locality to know their people they are better. So there is a home bias. If we tease that out a little bit more, then suppose that it is easier or to interpret loan applications of the in or dominant group in this setting. So in this setting, we have majorly Chinese. So let's say I'm more exposed to the people of my in group, or because minority may be disadvantaged or more constrained to pay, so I'm more exposed to non-minority. So in my personal risk assessment, my in-group application will have less noise. But when I go to the disadvantaged group, I use different threshold for each group, and I'm only willing to lend to the higher quality borrowers. And this is where the credit score becomes very important. So I see that without the credit score, teasing out this mechanism becomes a little tough, right? At the same time, if I'm not good at processing applications as a lender, I may not be very good in processing the application. So when this person comes to me, then especially for outgroup, I'll probably go by the online decisions. And that's why, you see that there is some rejection happening during the lender meeting the borrower. So this thing that why that is happening can be teased out a little bit more here. Another thing is that if this happens, then does this generate differences in profit? And following up, what about the heterogeneity? What I mean by that is just one scenario I can come up with is, Suppose that places with more COVID incidents have more homophilic network or worst opportunity for the minority. So there are certain areas of, which has more COVID because those people are more disadvantaged economically. So they have to go out more and they are more exposed. Then, it's very hard for the lender to learn about them, right? And finally, which type of borrower get benefited most by the anonymizing? That part probably we need to tease out a little bit more. Is it the smaller loan which gets more benefit? Is it the low financial literacy borrower who gets more benefited? Low education? So which type of borrower gets most benefit by anonymizing is another aspect we can look at. Before I close, there is this important paper missing in the reference, so I thought I will just bring that to the attention of the authors. Overall, it's a very topical and interesting paper. I had a great time in reading the paper. It's should definitely be well published and read well, and I wish the author all the best.
Thank you, Pulak, for really very wonderful, a very helpful discussion. I'm going to ask some questions myself. At the same time, I would like to invite those people who are not on the panelist group. Please, by all means, submit your question, and we can let you into the panelist group so that you can directly ask the question. Just signal to our administrators if you need to raise a question. Okay. All right. There are a few things I have in mind, Tianyue. I don't know whether Pulak has covered them fully or not, but let me try. The key issue here is really about racial discrimination versus statistical discrimination. One thing I feel, and I should read the paper again, but I feel is that you're using the post-lending performance to evaluate whether there is statistical discrimination. And I thought that the post-performance, the returning of the repaying of the loan and all those endogenous variable. How do you use that to eliminate statistical discrimination? So I just don't understand. I hope that you can shed light on that one. Then the other question that I have in mind is about if it is not statistical discrimination, is racial discrimination, and competition will really eliminate a lot of when you have all this wide open, the competition should really intensify, and as a result, the firms that the firms do not practice discrimination, then there should be some economic impact on that, and I think that's a lot what Pulak is talking about. Then the second point I have in mind is about, you have a lot of other information. Pulak talk about the rejection part. I agree with that. Another part in my mind is about, what about the officer effect? Is there any difference between an officer who's a Chinese and an officer who's a minority? And then also you have a lot of information on race, fees, maturities, and also the change of all these terms. I wonder if you have used those information in deciding on whether this is statistical discrimination versus racial discrimination. Thanks for listening. Maybe let me see if anyone is submitting anything. Maybe you can just respond to the comments.
Okay, cool. Thank you very much for Pulak for a very thoughtful discussion. And also thank you for bringing your question. It's very to the point. Maybe let me start by clarifying some of the institutional details. Okay, I think that's probably some of the details that I didn't have time to fully go through. So this platform, all the lenders, these are small financial institutions whose main business or primary business is to give out these short-term unsecured high-cost loans. You can compare them to, let's say, payday lenders in the US. So it's slightly different from T2P loans, where I know Pulak you have worked on, where individual investors can only invest to a portion of a loan. So multiple lenders lend to one people. But in our setting, each loan is fully funded by one lender and the lender can give multiple loans. And they do have the decision power of determining the terms. So as I said, amount, maturity, interest rate, fees. So in Singapore, there are restrictions. They face restrictions on the interest rate and fees. So in the data, we do see that many of them charge the legal limit of interest rates. So another way for them to adjust the cost of borrowing is from maturity, because if you think these are amortized loans, so if you fix, let's say, processing fee, the cost will be higher for the borrower if the maturity is shorter. So that is basically institutional details. So I mean, I think this is related to Bernie's point. The lenders do have control over, let's say, the terms of the loans. In the paper, we also show that the disparities in the extensive margin, so whether you get a loan offer or not, we also find similar but smaller differences in the intensive margin. So we find that minorities get smaller loans, shorter maturity loans. So as a result, the effective interest rate they face is slightly higher. So that is before the anonymization.
Both before and
no, before the anonymization. After anonymization, such differences are greatly reduced. But the intensive margin differences before is smaller in terms of economic magnitude compared to the extensive margin. So that is basically what we find. So I think that's one of the clarification I want to make. The second thing, I think, yes, we are. I think throughout the project, I think our main goal is to differentiate statistical discrimination, which has a rational underpinning in a way. It's just that information is fuzzy, okay, versus more taste-based discrimination. So in order to address this, we basically look at both ex-ante measures as well as ex-post measures. So for instance, ex-ante measures, we look at whether income does make a difference. So even in the highest income quartile, if we look at racial disparities in these highest income quartile, we find that the racial disparity before anonymization is similar to the full sample average. Basically, this exercise tells us that if you think income as a proxy, as an ex-ante proxy for repayment ability, this does not materially affect the racial disparities we observe in a pre-period. So that is one ex-ante measure. Ex-post measure, we look at loan performance, but I agree with you, loan performance is a endogenous outcome. We cannot fully rely on that. So that's why we kind of combine both ex-ante measure as well as ex-post measure to argue against accurate statistical discrimination. Accurate in the sense that the lenders believe should be accurate and correspond to, let's say, credit risk considerations.
May I interrupt you here, Tianyue?
Yes, please.
Let's focus on the ex-ante, the income. Okay. If you assume the income covers everything, okay, then you eliminate the possibility of using race as a proxy for other unobservable beyond income.
Okay.
So
yes, you are right. So I agree. So basically, we can do, for instance, we can also look at split by other measures. I think income should be an important consideration. That's why we focus on that. But you are right. It's not I don't think the test based on income can settle all the concerns. So we have done income. I think we can also analyze other, let's say, reasonable proxies for credit risk. So our approach would be, as Pulak suggested, we can look at heterogeneity in a wider set of observable characteristics to see whether they differ. So I think that's why the one thing I want to mention. So, and also I think time trends. So this is a fintech platform. So over time, the volume is larger and larger. So we do control for time trends in our, at least order regression analysis. So order regression analysis, the effect is net of the time fixed effect. So so that's how we address time trends. But I guess there's another way to look at this, which is what Pulak suggested. So we actually look at time trends itself. For instance, we can rerun the analysis by, let's say, comparing different time periods with, let's say, COVID restrictions. That's something we have not done. That I think that can complement our analysis on including the time fixed effects. And lastly, okay, I think there's another thing which is actually to-do list, which is this point raised by Pulak about the return to discrimination for lenders. So we can actually compare. Actually, we should do this as a next step. So we can actually compare those lenders who are more discriminating in the pre-period because they have the information they need to discriminate if they want. We can compare those lenders who are more discriminating versus those lenders that pay less attention to raise as reviewed by their decision. We can actually look at use the interest rates and fees information to calculate whether they what's the return or cost for them to exercise these discriminatory practices. And then I think these can
you guys don't have the credit score. Does the fintech platform
by the way, credit score. So in this
because that will help you to tease out the mechanism a lot more.
Okay, so for credit score, our understanding is that there's no FICO equivalent or like off-the-shelf credit score in this practice. So which means that the lenders will not just see widely accepted credit score on the loan application. But I think what we can do is, because we have the extensive.
But the borrower, the borrower are new to credit, or why the borrower doesn't have a FICO score?
Okay, so yes, so because the reason is that these are outside of the banking sector. So let's say if I go to a bank, okay, to take out a loan, the bank would access, let's say, a more uniform credit score through the bank credit registry. But these are, you can think of them as payday loans, okay, although it's slightly longer maturity than payday loans. So the registry actually for these type of payday loan, similar loans, does not.
No, I'm not talking about the loan, but I'm talking about the borrower. So the borrower should have a FICO score. Whether the fintech takes it or not, that's a different issue. But if the borrower, if not new to credit, if they have any credit before, no matter how small that is, whether from another fintech or something, they are automatically going to get a FICO score of their own, right?
So if they have bank loans, they would have a credit
bank
score.
Bank loan, or if they have a credit card also, they will develop a FICO score, right? So
excuse me?
Even if they have a credit card, they will develop a FICO score, right?
Yes, because these are credit extended by banks. But what I'm saying is that these loans are in a the registry system is independent or separate from the bank extended bank credit system. So the credit score for these borrowers, if they have bank loan, I agree they would have a credit score based on their credit obtained from banks. But such credit score is not available to either the platform or the lenders in this platform. So I guess, but I think credit scoring or credit quality is an important consideration. So the variables we observe include existing borrowing. So in a way, we can, although we don't have performance of this existing borrowing, so we can try to back out the credit quality also.
How does the platform decide whom to give loan, whom not? If they don't have the credit score, so they have their own scoring system. Do you know the cutoff of that scoring system?
Oh, so let me clarify. The platform does not make decisions, because the platform just send loan applications to these lenders who are financial institutions. They will make decisions themselves. The platform is just processing the application for these lenders.
Right.
And
So even the lenders, let's say, how does the lenders decide whom to give loan? If they don't, how does they figure out the underwriting model?
okay, so as we say in the paper, these are decided by human
I know, and that makes me
decision
more.
makers. So
Yeah, but that's where the
on
question
average,
comes
we do
more.
see that you know, if we can actually run a regression to analyze their decisions. So we do see
No,
that.
I'm not saying that. What I'm saying that if the AI is not taking the decision, because if AI is taking a decision, we can always say they are running a machine learning algorithm on all the variables and coming up with something. If human is taking, then human is either, either by the regulatory standard, they have to come up with a score based on the observable from the borrower, right? So do you know the cutoff score that, okay, using this, I'm coming up with this score like the bank manager does usually and say, if it is above this, I'm going to give loan. If not, I'm not going to give the loan. So there has to be some robustness in figuring out, but from the lender side, under what condition they are going to approve the loan or not, right? So that part was
yes,
not
I
clear.
agree. So what I'm saying is that there's no, for instance, I think of FICO as FICO score is the one score that is available to different lenders. I'm saying that there's no such uniform credit score that is available for different lenders. But you are right that lenders would have a credit score model in their mind. Okay, they will analyze credit quality, and they very likely will have a cutoff system. But this model can differ by lenders. It's something we do not have direct knowledge of.
I see.
Okay. Any other questions or comments or thoughts?
I wonder, if I may, I wonder if you
Please.
can use the minority. Okay, in the pre-change, the minorities perform better in the measured by the delinquency rate.
Okay.
Is there any? So what I have in mind is, there's any way to look at the I mean, there are two things in my mind. Number one is that for the minorities, after the change, there is, maybe I will talk to you separately. My mind
Okay,
is not
sure,
really clear
no
on this
problem.
part.
We'll be
Yeah,
around.
but then
You
there's
can talk
another
to
thing, like,
me and Pulak.
because we're in the same buildings and so on. My second question, is this: do you have any information on the officers making the decision?
I see. Yes,
You're
that's
right.
something
So
I want
that's
to-
point one. And then the other thing is, like, in the revision. So after the interview, there's yes, continue, or no, reject, right? It's almost like revise and resubmit, accepted, and revise and resubmit, and rejected. Is any difference between the accepted and rejected in the R&R? Between the Chinese and non-Chinese?
Okay, so first of all, lenders, we collected their business registration information. So basically, we all but one lender is full Chinese based on their names, and we can also know, for instance, where they live in Singapore and their age, and maybe gender. We can decode that to some extent from the names. Those we have not used in our analysis, but that's the kind of the data we have collected on them, so we can probably explore. I think one thing that will be very interesting is to see the experience, that's the age as a proxy for experience, whether more experienced lenders treat these two race groups more differently or more similarly, because you can go one way or the other. So that's what we have on the lender side. But most lenders are Chinese, so that's why we didn't do this in-group versus out-of-group analysis, because the power is going to be an issue. That's the second thing is about the origination stage. So as I mentioned, even after you choose the loan, because the origination can fail for various reasons, because it's indeed like a revised risk survey. It's not guaranteed that you will get a positive outcome at the end. So we have not. I think we can definitely do more in terms of origination outcome, because right now we analyze the extensive margin, which is whether you get a loan at the end or not. But there's also, you know, for instance, the origination, the terms, the amount versus what is offered to you at the beginning, and maturities and so on and so forth. We can definitely do more on that front.
But we'll
also
talk
in the
more.
origination, is there any gap time in the sense, does the lender takes a decision immediately, or they can sit on it for a day after they meet the borrower? So if there is a variation from the time they meet to the decision taken, that gap time can be also interesting.
Oh yes, yes, that's definitely true. So, yeah, I think let's see. I think we can check our data whether there's any meaningful variation there. Yes, that's a good point. Thank you.
Okay, well, thank you for a really very good paper. Like Pulak said, it deserves publication, and all the best for that. And thank you, Pulak, for really wonderful discussions. I thank people for attending, even though it's a holiday for many regions in Asia. And in May and June, we are going to take a break because we're having the ABFER main conference. And so I'll see you all in July. Thank you. And by the way, I also hope to see many of you in the main conference in May. Thank you. See you in Singapore.
Thanks, Barney. Thanks, Tianyue.